inflation start to come through and prove to be more persistent than had originally been assumed. And then when Russia invaded Ukraine, it sent energy markets and other commodities spiking. And so we saw this inflationary picture exacerbated and spiraled. And so in response to that, central banks quickly raised interest rates, and that sent equity markets and bond markets down at the same time. So looking over a year, the black line at the top, the best performing market has been European markets, but that's largely as a result of being the region that was hit most hard in the initial aftermath of the Ukraine invasion, obviously with Europe being the most reliant on energy and other commodities from Russia. So the European markets have recovered quite strongly. UK markets likewise have done quite well, and part of that is to do with the makeup of the market. So the UK market tends to be made up of sort of old economy stocks, things like oil and gas, banking, tobacco, utilities, and those are areas of the market that performed particularly well in 2022 and have been relatively stable through most of this year. The red line at the bottom, that is the UK government bond index. So that is a part of the market that we would normally think of as risk-free. If you hold these securities until the end of their term, you get the full payment back. The UK government will pay you back. They can print money if they can't, so they will pay you back, and you get your interest paid during that period. So usually seen as the risk-free rate. From January to September last year, so that's through to the mini budget Liz Truss's government put forward, we saw this index fall by 25%. So this is normally seen as your risk-free rate. Well, a fall of 25% does not feel very risk-free. So in a multi-asset portfolio of equities and bonds, we saw there was less protection than we would normally expect from that sort of diversification within the portfolio. Looking over the last 10 years, it's been very much a story of the US. And that has continued through this year, although the US markets languished a bit in 2022. It's really been a story of growth and technology stocks in the US, which have dominated market leadership over the past decade. In terms of what's been happening this year, I've mentioned the US market is back in vogue this year. But actually, if we look at the S&P 500, that's the 500 biggest companies in the US, actually the vast majority of that performance has come from just 6 companies. The companies listed there on the screen: Apple, Meta, which owns Facebook, Alphabet, which owns Google, Amazon, Microsoft, and Nvidia, which makes computer processing chips. And so if we strip these companies out and looked at the S&P 494, it's actually not much better than flat for the year to date. So it's been a very, very concentrated performance in markets this year, dominated by the mega cap stocks. So if you've not had up to the benchmark weighting in these stocks, it's been a significant headwind to performance. And for active managers, actually holding 12% in Microsoft or Apple is not something we would look to do from a diversification standpoint. So in terms of the common good fund itself, we manage this on the basis of a risk category 6. That's on a notional scale of 1 to 10, 1 being very low risk, sort of cash under the mattress, and 10 being very high risk, betting on a horse race. We offer between 3 and 8. And so 6 is sort of roughly in the middle, fairly balanced, still a predominantly equity-focused risk mandate. So we've got about 70% of the portfolio in company stock. We've got a time horizon of more than 10 years. The investments are there in perpetuity, and we're investing primarily to fund charitable distributions as a result of the income, and also to protect the asset base against inflation, something clearly that's been particularly challenging over the last year or so. that just gives you an overview of where we are in the risk category. So you can see it's roughly in the middle, but slightly at the higher end, slightly more equity focused than a risk profile 5, but a balanced mandate and you know, significant weightings to fixed income and alternatives, things like gold, property, and cash, which typically would hold up during periods of equity market stress and give the portfolio some balance. So here's where we're sitting today. As at the last valuation point, the Common Good Fund was valued at just over £800,000, £809,000, and the performance over the year to date were slightly down, and the benchmark is very marginally up. So that's a slight underperformance over the year to date, largely for the reasons I mentioned, primarily the relative performance in the US, which is now the largest weighting in our equity allocation, which it's bigger than the UK element now. Over a year, again, we've seen markets fall quite sharply, and it has been a challenging year for the portfolio. A lot of what happened in 2022 was the sorts of stocks that were doing well, things like defence, tobacco, oil and gas. We tend to be underweight or have no weighting in these parts of the market, given the nature of charity investment. And so we've actually put there the ARC steady growth figures in. So that second one, which is an aggregated performance of similarly managed charity portfolios. So it's a slightly clearer comparison, whereas risk level 6, clearly that's the chosen benchmark, but it's an unconstrained approach with no constraints on the sectors that we can invest in for the charity. And over the long term, the portfolio has performed ahead of the peer group benchmark, albeit behind the more unconstrained risk category 6. The income generated in 2022 was just over 20,000, and in looking ahead for the full year 2023, we anticipate a slight uplift on that, about 20,500, and that is partly as a result of rising interest rates, which have meant that generating income within the portfolio has become slightly easier. The bond element of the portfolio is now generating much more attractive returns than it was, and so we have shifted our allocation slightly more towards bonds, and particularly UK government bonds. So the portfolio is currently yielding about 2.4%, and that is an uplift on the benchmark yield, which is 2.1%. But we don't want to push that too much higher than the benchmark, given that it constrains where we can invest and would necessarily mean we have a lower weighting to things like growth stocks. So companies that reinvest their profits for growth tend not to pay out dividends, but they have been the best place to be in terms of capital growth for the last 10 years. So while we do have a superior yield, we don't want to push that too hard. In terms of the asset allocation, as I mentioned, our weighting to fixed interest, we're now slightly overweight in our fixed interest element. If we looked at the portfolio, say 3 years ago, when interest rates were sitting near 0%, we'd have had a significantly underweight position to fixed interest. But we have brought that weighting up significantly over the last year, and being underweight was the right place to be while interest rates were low. But we do think we're now approaching the top of the interest rate cycle, and so being able to lock these these higher rates in for longer, we think will be beneficial to the portfolio. We've got a broadly neutral position in equities. We still feel that equities will provide the best opportunities for long-term capital growth and the best returns going forward. But you do get a lot of volatility in equities. And given where we are and the uncertainty that's still around, we still feel that having a neutral position here is sensible. We're not prepared at this moment to go overweight, given the possibility of a recession as we move into next year. Taking a more granular look at what's done well and what's not done so well, the top performers since your most recent year end, unsurprisingly, the S&P 500, which has done fairly well, largely, as I say, as a result of the big, large cap technology stocks. Elsewhere, it's been a story of the sort of higher quality equities within the portfolio: Admiral, Relics, and Halion, which all are sort of high quality compounders with recurring income and are likely to be resilient in the face of a recession. Shell fell towards the end of last year, but has had a much better 6 months and primarily the last 2 months or so, with the geopolitical instability that we've seen, which has driven oil prices up and has helped oil price shares. On the bottom half, the main thing here is infrastructure. Infrastructure assets tend to be quite interest rate sensitive. So we see interest rates go up, infrastructure assets tend to fall. And part of that is to do with the returns, the stable return profile, which say you're getting 8% as a steady yield on an infrastructure asset, and suddenly your risk-free rate comes up to 5%. Relatively speaking, those are less appealing, and so become out of favour with markets. But also, they tend to have quite a high debt balance, infrastructure assets, given the nature of their funding streams, and so higher interest rates tend to hit profits as well. In terms of transactions, I won't go through these in minute detail, but we have been adding to bonds. We've been enhancing the US element as well, and trying to broaden diversification in that respect. Market thoughts. I've covered a lot of this, but inflation and interest rates will continue to be the. Have we lost Andy? Is that okay?
We've switched interpreters, so you're fine.
Sorry. Fine. Yes, inflation and interest rates will continue to dominate markets over the next 18 months, and so we're watching that closely. Inflation is coming down quite sharply, but a lot of that is to do with the fall in commodities prices after the spike last year, and more normal commodity prices after sort of artificially inflated values in line with what was happening in Eastern Europe last year. But if we look at the underlying causes of inflation, so if we strip out food and energy costs, which tend to be the most volatile, what we see is that core inflation has been a little bit more stubborn. And I think central banks will want to see that fall much more meaningfully and at a more sustained level before they are comfortable taking their foot off the gas. Interest rate rises, typically a typical interest rate cycle, we see inflation and economies heat up, inflation rise, interest rates in turn rise, cool the economy, and then economies growth starts to reduce. What we've seen so far this year is economies have been more resilient than had been anticipated. So at the start of the year, the assumption was that the UK would fall into recession, the Eurozone would likely also fall into recession, and the US, while avoiding recession, would generate very low growth and be flirting with it. As we've gone through the year, in fact, the UK has staved off recession, the Eurozone has staved off recession, and the US has actually shown quite robust levels of GDP growth. So we've yet to see the interest rate rises having a severe impact on economies, but interest rates, we do still think that the interest rate cycle is coming to an end. The expectation is that we'll see 1 or 2 more interest rate rises before the end of the year, but that's likely to level off as we move into 2024, and possibly, depending on whether we fall into recession or not, then come down. But at the moment, central banks are indicating that the interest rates will be higher for longer, and so that is something that we have to factor into our investments. I think one of the reasons why the economic impact of interest rate rises hasn't been felt yet is related to fixed rate mortgages. So I don't know where everyone else is. I'll be remortgaging my house next year, and it could be quite painful given that I fixed it 2 years ago when rates were low, and the interest rate rises really will hit me about June next year, so not something I'm looking forward to. But a lot of households will be in a similar position where those fixed rate mortgages are rolling over into either variable rates or new fixed term mortgages at much higher rates than they were previously. So perhaps that pain's still to roll through the UK economy. Interestingly, in the US, typically it's much more common to have a sort of 30-year fixed rate mortgage in the US. So many of householders in the US will be fixed at very low rates for decades to come. So the US tends to be much less interest rate sensitive, as the consumer in the US is much more insulated from interest rate rises, primarily due to fixed mortgage rates. So we do anticipate that as we move through to next year, there is a reasonable possibility of recession in the UK, but the US and also the Eurozone are less likely to fall into recession. I've covered a lot of these. I think the main things we're looking at in terms of the way interest rates and inflation could go, there's the possibility of a soft landing, where the economies start to cool, inflation cools down likewise, and interest rates come down in turn, but without crashing economies. And that would be positive for equities and also positive for bonds. So that would be a good scenario. A hard landing where we see inflation cool down sharply, but also economies faced with recession, and that would be negative for equities, but it would be positive for bonds. There's also, we're looking at the possibility of an AI boom. There's been a lot of enthusiasm around artificial intelligence so far this year, and it's been one of the key drivers of the mega cap stocks in the US, the technology names, particularly Microsoft, Google, but also Amazon, Nvidia. And so that's something we're keeping an eye on. If inflation was to come down, but we saw an AI boom, then that would also be positive for equities. And that's, but we think the most likely scenario is probably a soft landing or a hard landing, as opposed to an AI boom, or of course the last one is stagflation, where we see inflation remain high, but economic growth languishes, and we go into a recession, but also we have high inflation, which would be the worst of all worlds. But we think that's a fairly unlikely remote scenario. I've covered off this. The last thing I'm going to end on is just a chart of the S&P 500 through the years. We've been through many geopolitical crises before, and markets in the short term can experience significant periods of volatility around these. But for patient investors that have been able to stay the course, avoid drawing down significantly on their assets, they have been rewarded over time. So we continue to think that the equities will yield over the next decade and more, albeit we're likely to see some volatility in the interim. I'll stop sharing. I don't know if anyone's got any questions.
Well, thank you so much, James, for those questions. Please can I ask members for any comments or questions? Andy McFarlane.
Oh, yeah, thank you, James. That was very interesting. Very much of what you said. I suppose we've probably read within the papers that we've already got. A couple of questions I would have. I thought it was very interesting that one of the graphs you showed, that UK inflation is slowest of the major markets, that growth is lower than most of the major markets. I'm also a member of the pension subcommittee, and one of the things that they've done is they've looked to disinvest in UK stocks and shares and gilts and whatever else because of just that. So I'm wondering, I think you said it was about 17% or so we've got in the UK, and I'm wondering what you're going to do with that, if you're going to have a look at that. First question. Second part was, do we have a statement on the ethics and carbon neutral, etc.? Because a couple of three times you mentioned oil and gas, which are obviously carbon intense. So are we looking at disinvesting in that and looking at alternatives, perhaps renewables and such like?
Thanks, Andy. So on the UK point, we have been continually reducing our UK weighting from a strategic perspective. So as I mentioned, the US now is comfortably the biggest position within global equities. So, historically, UK investors tended to invest in UK stocks, and that would have been the biggest weighting in the portfolio. But I think there's a recognition that UK stocks now, that's, you know, having exposure in your own currency has a benefit, has a bit of a safety mechanism, but actually many of the biggest UK stocks, most of their revenues are generated overseas in any case. So you've got currency risk whatever way you cut it. And we still think the UK for income investors particularly is attractive. They tend to have high dividend yields. We think valuations are low. There's a reason for them, for valuations being low, but we think that perhaps they are slightly undervalued. So we're not looking to reduce our weighting significantly from where it currently is. But I think the current weighting is less than 20%, and I think we're comfortable with that. We tend not to, you know, when we're investing in the UK, we tend not to be investing in companies which are overly sensitive to the UK economic picture. We tend to invest in big international companies which will be able to grow their dividends over time and aren't overly affected by the UK domestic economy. So in some ways, the asset allocation split that you see within the overseas and UK element isn't necessarily reflective of where these companies generate their revenue. You know, it's called a UK equity if it's listed in the UK, but it may generate 90% of its revenue in the US, and therefore what's happening in the US economy is far more relevant. So I think from that perspective, you can find some UK names which, purely by dint of the fact they're listed in the UK, you can get them for cheaper than you'd get the equivalent listed in the US, even though largely they're the same business trading in the same locations, in the same sectors, doing the same thing. So there are opportunities in the UK market, but I would say we have been moving away from having a large UK element and towards overseas, and particularly the US. On the ethics point, I don't believe we have anything in place at the moment for the Kirkcudbright Common Good Fund. I don't think there's an investment policy.
We're short for time, so if we can just be brief on that point, thank you.
Yeah, sure. But that's really all. There's no ethics in place at the moment, but certainly something we can help discuss if that would be useful.
I did have another point, but clearly John wants to move on.
I'm sorry, we do need to move on just to keep with time. We have another meeting at 2 o'clock. So
if there's any other questions, please feel free to email me.
Yeah. Okay. So to go into the main report, are there any other? On the James's report, are there any other questions on James's main report? No, have we covered that? Well, thank you so much, James. And we'll now obviously turn to the main report and move to recommendations. We have agreed the financial objectives for the financial plan, being to maintain the financial health of the funds and to maximize and manage the level of free income available for distribution by the Common Goods Subcommittee is detailed at 4.6. 2.2, agree the financial plan for 23-24 is set out in Appendix 1. And 2.3, note to the financial outrun for 22-23 in Appendix 2 and the balance sheet Appendix 2. 2.4, note that a representative from Brewin Dolphin will be present to answer questions on the investment and interest income for 22-23 as detailed in Appendix 3. Can we all agree on that? Thank you. Agreed. Moving on to item 5. Which is the application for financial assistance from Kirkcudbright Common Good Fund, report by the Head of Community Services. This is our second report today. I'd like to ask members to consider an application for financial assistance for the Kirkcudbright Community Council have made an application to the Kirkcudbright Common Good Subcommittee for 8,000 of financial assistance towards the purchase of a delivery and installation of a vehicle activation signs on the A711 at the south of the town. Can I ask Ward Manager Ingrid Gemmell, is there any answers here to answer any questions? Over to Ingrid.
No, thanks, Chair. Nothing further to add to the report. Thank you.
Any members want to comment or make any questions on this report, please? Andy McFarlane. Thank you, Councillor
Hi,
McFarlane.
Ingrid. Hi, Ingrid.
Morning.
It says at 2.1 we've got a balance of 21723. And having just listened to Brew and Dolphin, on page 8 it says 21734. Now I know it's only £11 or so, but do we know which one's the right one? I don't know.
The 21723 is what we have in terms of budget that can be allocated.
Yeah. I think this is a reasonable suggestion. I'm not convinced that the effectiveness of it, because I'm aware of the other ones in the town, and whilst I think that they do flash, there's one in the middle of Kirkcudbright at the bottom of Burnside loaning, and it's always flashing, which means that people are always driving faster than they should. However, I do think it's good, a good way of indicating to people that perhaps they should slow down. So thanks.
Okay. Ingrid, do you want to respond to that?
I think it was more a comment than a question, to be honest. I hope I'm right in thinking that.
Anybody else, any other members want to contribute? Okay, if we can move on to recommendations. 2.1 notes that the remaining forecasted fee income balance of 21723 is available for disbursement to 23-24 financial year. 2.2, note the agreed grant criteria for funding as detailed in Appendix 1. 2.3, agree award to the applicants as detailed in paragraph 4.11 and Appendix 2. Has recording stopped? Someone's asking why recording has stopped. Are we continuing to record? Can I check with you, Abby?
It must have been
Sorry.
James who's gone then.
Okay, thank you. Thank you for that clarification. Yeah, I just wanted to raise that for that purpose. Okay, so are we okay to go with that recommendation? Okay, now move on to number 6, Kirkcudbright tennis and land, 2 courts and clubhouse building, community asset transfer, and that's for St Mary Street, Kirkcudbright, DG6 4AA. Report by the Head of Community Service. So our third and final report today asks members to consider an application from Kirkcudbright Community Tennis Club under Community Empowerment Act Scotland 2015 for transfer by way of ownership of Kirkcudbright Tennis Club and land, 2 courts and clubhouse. Members of this committee are asked to make a recommendation to the Council's Finance Procurement and Transformation Committee to in turn inform their decision. So this report contains a great deal of information to help inform members, including a 2-stage application, Kirkcudbright Community Tennis Club business plan, the officer assessment and social value. Yep, so if anybody has any comments or questions to make on that, please make that known now. Councillor McFarlane, please.
Yeah, I think Ian Howie's come in first.
Yep, that's fine. Yes, yes, Ian, please. Thank you. Ian, I think you're maybe on mute.
There. Sorry, Chair. Was struggling to get the mic off. No, this sounds a very reasonable application to come forward. I am in favour of the local community taking on projects like this. Only a comment to make and a suggestion for future ones coming forward to request that consideration be given to the Community Land Fund, the Scottish Land Fund, which would allow contributions to be made for these assets to go to the Common Good Fund, but I have no objection to this one being progressing as it present form.
Okay, thank you. Okay. Lindsay, have you got anything to add to that? You want to respond?
Yes, the Community Council is not in favour of this. The Community Council notes that by your own statements, the land has been valued at £100,000. This is not reflected, for example, on the so-called balance sheet of the Common Good Fund. Why not? We think that the asset should be leased to the tennis club for a period of 25 years at least, and that this should be recorded on the accounts as a note for this going forward in perpetuity. There is no safeguard as far as we can see for this land to be returned to the Common Good Fund should the tennis club fold in the future. So our recommendation to the trustees of the Common Good Fund is that this be done by way of a 25-year lease, which is in the same process as is happening with other Common Good Fund assets in the borough.
Anybody wanting to discuss that further?
I have a couple of comments and got my hand up.
Andy McFarlane, yes, please. Andy, yep.
Yeah, thank you. Ingrid, thank you very much for pulling this together. It's an excellent report, and I think that the work that the Community Tennis Club have done is excellent. Just to pick up on something that Lindsay just said was that the Community Council don't support this, and yet on page 61, it's they're the very first named in support of this, so I'm a little bit conflicted in relation to that. A couple of things that I was going to ask was if we were to sell this if we were to transfer it to the Community Tennis Club, would the council have first right of refusal should anything such as Lindsay's just outlined happen, and would it be able to get it back into council ownership, or would they be able to just sell that on? And secondly, if it was to go ahead, what steps would the club take to make sure that it was affordable? Because tennis is one of the most expensive sports to play because of the equipment, etc., and people you need. And clearly, we're living through a cost of living crisis. Deprivation in this area is significant. And if we want it to be inclusive, what steps would they be taken to try and make sure that it was accessible to everyone in the community? Thank you.
Thank you, Andy, for that. Anyone want to add anything to that before we move on? Ian?
If I can just, I was just going to come in response to the questions, if that's okay.
Yes, Ingrid, please do, yes.
So the first thing to mention is that the request that's come from the community group is that they wish to take on ownership that is the request that has come in. It's a community asset transfer request for ownership for £1, but there could be, if members decided, conditions set on that in terms of return. I know that my colleague Julie Shannon is in the call. Maybe Julie, I could pull on you to help and support in terms of some advice around that, but there certainly could be in terms of clawback conditions set around that. And just in terms of the membership question, Councillor McFarlane, the Kirkcudbright Community Tennis Club are striving to be that a community tennis club, so they have been making significant changes as to the way that they work to make sure that the community can be as involved as possible. So I hope that helps to alleviate any concerns there. Julie, I wondered if you could just come in on the point around the conditions and the clawback, if that's okay.
Yes, please do. Yes, Julie. Yes,
no problem. Morning, everyone. Thank you, Chair. Yes, in circumstances like these, what we have done in the past is asked for the group to enter into a standard security in favour of the council with a minute of agreement attached, and the minute of agreement would have various conditions in it. Perhaps, as has been alluded to by Ingrid and others on the call, that if they were minded, if the tennis court wanted to sell it on, they could potentially come back to the council first and say, well, you know, it's called a right of preemption, and it basically means that the council could have first refusal on that ground on the tennis court if the tennis court were to sort of wanted to sell it on. I suppose in addition to that, if there's a value of £100,000 sort of that's been stated, if the council didn't want to claw it back, that is the property, then they could potentially ask for sort of a payment to be made back to the council, depending on, and this is we have done in this past, not necessarily with the community asset transfers, but with other council assets. Say it was to be sold within, I don't know, say 1 year or 2 years or 3 years, we could ask for a proportion of the value to be paid back to the council. It's not something that we have done often, but it is something that we have done in the past in other transactions. Or alternatively, you could ask for a title condition to be placed on the ground to say that you wanted the ground to be used as a tennis court in all time coming. And that would sort of secure the land for that purpose. So I hope that's provided a wee bit of clarity to that question, but happy to respond to any other questions that you may have on that.
Thank you, Julie. Ian Howie, would you like to, have you got a question for Julie, or you wanting to contribute?
A question for Julie. A similar situation in Castle Douglas when it was the outdoor centre. Now, I appreciate that went down the road of a lease as opposed to a transfer, but I think to bear in mind what you're wanting is some way that the property doesn't go back to the council, it comes back to the common good. Totally different organisations at all, and the common good could be find themselves left out if there was a return. So I would strongly urge you to ensure that in that scenario that the property comes back to the Common Good Committee.
Noted.
Andrew, you're on mute, sorry.
Sorry, I was waiting to be invited in. I was waiting to be invited in. Thank you. Yeah, thank you for that, Julie. Is it possible then? I mean, clearly the council took possession of this, and I know take the point that Ian's making in relation to it being common good, but the council obviously are owners, but are constrained by the fact that it is common good land. So if we refer to the council, we are talking about, or I will be talking about common good at the same time. If we were able to sort of put in a caveat that the council would have first refusal on it. You made mention about if they were to sell it, but are we able to put a restriction on that they have to sell it as a whole? You know, because what we wouldn't want is for them to sell as the clubhouses, for example. So we'd be able to put a caveat that say that we had to have first refusal, it would come as a whole item, and if that were the case, that we would pay the pound back, you know, we'd be buying it at that value. Or could we put on a caveat that if they were to sell it, that we could recover the cost, the value at the moment, which is £100,000, at the market value at the time. So building in inflation, that sort of thing. Just a couple of little things there, I think.
Yeah.
And if we leave it as a lease, I'm guessing that there's probably administrative costs that we would have to bear as a consequence of that. Thank you.
Yeah, certainly. I mean, you can put, as I said earlier, you know, you'd ask the group to grant us a standard security and attach that standard security. There'd be a minute of agreement. The minute of agreement would contain whatever conditions you deemed to be fit that they would have to comply with. So, as you say, it could be any of those things which you have just sort of referred to in your question. With regard to the question of the lease, and it would be a sort of long lease of 25 years, again, there would be costs, but it would probably be, I think my sort of colleagues within sort of property services would be more able to give you an indication of what those costs would be, and I'm not aware that anybody from property services is in this call today. But again, we have done in the past community asset transfers of leases of 25 years, and I believe they have been sort of quite successful.
Oh, well, thank you. Lindsay, final
comment.
Could I
interrupt?
Please, Lindsay.
Mr. McFarlane, I'm sorry if there's confusion about where the Community Council stands, but I was not, apparently, maybe I've missed a meeting, but I think that the Community Council's views need to be clarified. After all, it is a common good fund asset. The Community Council, as I understand it, and I think we should clarify this, and there seems to be no unanimity amongst what I've heard from today. Ian Howe's making certain comments about Castle Douglas, etc. But the Community Council, as I understand it, wants it to be the subject of a 25-year lease. That will in no way impinge upon the activities of the tennis club. They exist perfectly well just now, and in fact doing a super job. I should express a slight conflict here in that I prepare the accounts and reports for them as the external examiner for their accounts because they're a SKIO. So I would suggest to you, gentlemen, that this be further discussed, hopefully with somebody, one of the trustees present at the Community Council meeting, so that it's clear as to what we are actually taking a view on here, and that this be carried forward. Thank you.
Okay, thank you for everybody's points. We now need to move on to recommendations, and that is 2.1, to consider Kirkcudbright Community Tennis Club's transfer request as laid out in the Stage 2 Asset Application Appendix 1 and Community Business Plan Appendix 2. 2.2, consider the outcome of officer assessment of the request in relation to the Council's requirement to meet best value as detailed paragraph 4.5.3 and the officer recommendation at paragraph 4.9. 2.3, note the outcome of the social value asset of the proposed transfer as detailed at paragraph 4.6.2. And 2.4, note the outcome of the social value assessment of the proposed transfer detailed paragraph 4.10 to recommend to the Finance, Procurement and Transformation Committee. Councillor McFarlane.
Yes, Chair, thank you. But having gone through what the recommendations are, we were given 3 options on page 65 and 66. And I really don't feel that we've discussed them, so I don't think we're really in a position to go on to the recommendations of the report without deciding which of those options that we wanted to proceed with, unless you're going with Lindsay's suggestion that we postpone making a decision till we get further clarification from the Community Council.
Ingrid, could you advise us on next steps?
It's in the hands of members. It's a member decision. I've certainly brought this report forward, stating that this is based on the information that I have received, and I did speak to the Community Council or representatives from the Community Council when pulling together the report. It is ultimately a member decision. And there is, members would be able to set conditions, as was stated earlier on by myself and Julie. So there could be, alternatives to the options that are presented in the report if members were minded to set other conditions, bearing in mind that, those conditions need to be justifiable. So.
Thank you, Ingrid, for that overview. In light of those conditions and this discussion, can I suggest that we postpone this for a further to our next meeting before making a final decision? Councillor McFarlane, final comment, please.
Yeah, I was just going to ask Ingrid, would we need to set the conditions at the moment, or is it something that we could go off and resolve elsewhere and then come back?
I think it would need to be that you would set your conditions, and that's what we would be presented to Finance, Procurement and Transformation Committee, and that meeting is due to take place mid-November. So there would be some impact in terms of taking the reports forward. But again, it is a member decision. Julie, I don't know if you want to come in any further on that or not.
No, I think you've set out the position quite clearly, Ingrid, to be honest.
Okay, so what we've agreed with Councillor McFarlane's suggestion is that we'll consider these conditions, we'll agree them, pass them on to the relevant committee, and then bring that back to our next meeting where we can have further discussion. We need time to be able to review those options, and if everybody's in agreement, then we can move ahead. Ingrid.
If that were to be the case, then the conditions would need to be considered today, and the recommendation would need to be made today, so that I could then in turn take it to the Finance, Procurement and Transformation Committee in November. So members would really need to make a decision in terms of recommendation this morning.
Okay, Councillor McFarlane.
Yeah, I think that was the question I was asking, Ingrid. Do we need to consider those conditions if we were to decide to go ahead with the asset transfer? Do we need to consider those conditions just now? So I think the first decision we have to make is, do we want to go ahead with the asset transfer? And if we do, what conditions do we want, if any? And the third option, because it is what they say on page 65 and 63, the alternatives are you just grant it and give it away, as it were. You give it away with conditions, or you refuse it. So I think that's the position we're in.
I'm
the members' comments, please. Lindsay.
I'm not happy about this, and I'm not bothered about whether or not this upsets council and future meetings, etc., and whether or not. My clear instructions from the last meeting I had with the chairman of the Community Council was that the Community Council is not in favour of this asset transfer. This is an asset worth £100,000, and whether it's transferred to the tennis club or not will have no effect upon actually what the tennis club actually does, but it does have a major impact upon the Common Good Fund. And I wish the Community Council's views to be crystal clear before you proceed. I'm sorry if there's apparently on the face of it a misunderstanding brought by Trustee McFarlane with what I've been set to do at this meeting. But I really honestly think you should postpone it. This is not going to affect the tennis club one iota. And if it upsets council officials, I'm sorry, but that is that.
Okay, I'm conscious of time and comments that people wish to make. Lindsay makes a valuable point, and I, as the chair, do want to recognise that and decide that we postpone this discussion. We speak with the Community Council, we look at the report, and we will just need to have to wait until mid-November to make the next recommendation. So, Ingrid, any further comment?
Not really. I was just going to come in and say that members could, there is that option to make, again, just saying that members could make a recommendation today, but it's in the hands of members. The report that I'll bring in November will be the same report. The content is not going to change. The question just is about which option members choose to take forward. And I think both Julie and myself have made it clear around kind of clawback conditions, and that those can be set. That is in the gift of members to make that decision. Again, I'm in the hands of members though, and if the decision is to defer, then it's to defer.
I'm just very conscious of the timing of things in this discussion, and so I need to make a decision as a chair that we need to defer this matter to the next meeting. So we'll close that matter there. Any other business? Any other business denoted by the chair due to the need for a decision? I have no urgent business, so that concludes the meeting. Could I thank you all for your contributions? Cheerio.
Not happy at all. Ingrid. Ian.